Good afternoon, and welcome to a special Simon webinar presentation. Entitled Insights from the Top, this webinar series aims to showcase alumni experts and business leaders in the Simon community. I'm Sevin Yeltekin, Dean of the Simon Business School, and I'm pleased to introduce our distinguished alumni guest this afternoon, Professor Ken French. An expert on the behavior of security prices and investment strategies, Professor French is revered for his research on multi-factor asset pricing models. He currently serves as the Roth Family Distinguished Professor of Finance at the Tuck School of Business at Dartmouth College, where his research focuses on tests of asset pricing and the trade-off between factor exposures and expected returns in US and international financial markets. Professor French is also a research associate at the National Bureau of Economic Research, an advisory editor at the Journal of Financial Economics, a former associate editor of the Journal of Finance and the Review of Financial Studies, and a former president of the American Finance Association. Professor French holds a PhD in finance from Simon, where he also earned an MS and MBA. Today's interview with Professor French will be facilitated by current Simon M.S. in finance student, Philip Patyk. A resident of Austin, Texas, Philip joined Simon this year, about 7 months ago, after receiving his MBA from Texas State's McCoy College of Business. After completion of his MSF degree, he aspires to transition to a career in investment research, asset management, or private equity. I am very excited for the conversation today, and it is now my pleasure to turn the mic over to Philip and Ken. Philip, please take it away.
Thank you for the introductory remarks, Dean. So Ken, I'd like to start some 40 years ago. Can you tell us about your experience at Simon and how it has impacted your career?
Well, you had to lead with the fact that it was 40 years ago, huh?
Yeah, I mean, 40 successful years, so.
Okay, 40 successful years ago. Yeah, I had an incredible experience when I was at Simon. At the time, it was just the GSB, Graduate School of Business. And it was, I always think of it as a remarkably entrepreneurial place. I actually did my MBA in essentially 1 year. And it was simply because the faculty were entrepreneurial. They were willing to allow me to do what I could to get everything accomplished, and I did. And it was a phenomenal experience. Lots of personalized attention. I spent many hours in Bill Schwartz's office. Bill recently retired, but he was the editor of the Journal of Financial Economics for many of the last 40 years, and a tremendous mentor. I spent lots of time with Cliff Smith, Mike Jensen, even Bill Meckling, who was the dean at the time. It was a wonderful place to get an education, and my sense is it remains that for many of the same reasons.
Yeah, and that's very wonderful to hear. And that sounds like an incredible roster of individuals that you just listed that were at the university at that time. So I'm curious, what made you want to go into financial research specifically and maybe pursue a PhD?
It was literally the experience I had as an MBA student. I was working for Bill Schwartz as his research assistant. And as I said, I got to know a lot of the faculty. I got to see the sort of research they were doing. And Bill, to his credit, even at that age, he encouraged me to just start doing research. And I published my first paper from something that I wrote while I was an MBA student in between the summer between my MBA year and the first year of the PhD program. And it was, it was at Bill's encouragement and with a lot of support from him. And it turned out I really enjoyed doing that sort of thing.
Yeah, okay, well, that's great. So you've mentioned Bill Schwartz. I've always been curious about another frequent collaborator, Gene Fama. And I'm curious how you two connected and maybe what substance he adds to your collaboration.
Well, I have a strange path for, at least in the olden days, a finance PhD. I was a postdoc. After I finished my PhD, I did a postdoc at UCLA for some weird reasons, but really rewarding reasons. And Gene was spending the winter at UCLA, and he taught a PhD course, and I sat in on the course. And in talking to him, both in class and outside of class, we got to know each other and enjoyed interacting. And fortunately, he was able to convince his colleagues at Chicago to hire me, and I leaped at the opportunity.
Yeah. Okay, that's wonderful. So you and Gene developed the renowned three-factor model in a published paper in 1993. How would you describe the model to a general audience, and why is it important?
What the model is trying to do is identify differences in the expected returns across stocks. So there's three parts to the model. That's why it's called a three-factor model. One factor is just the return on the market minus the risk-free rate. It's the same component that's the core of the capital asset pricing model. And what we did was we added two other factors to it. And the two factors came about because we'd written a paper a year earlier where we looked at the cross section of expected returns and said, you know, small stocks tend to have higher average returns than big stocks. And then value stocks, companies whose book value is high relative to their market value, they tend to have higher average returns than growth stocks. Companies whose book value is low relative to their market value. And so we had these two patterns, the size effect and the value effect, and we said, can we make a model that captures those two patterns? And that's what the other two factors are about. And it turns out it's useful for predicting differences in expected return. And it's also useful for portfolio design and performance evaluation, trying to decide whether, say, an active manager has actually delivered anything that you could not have gotten just simply from a passive portfolio with the same style tilts. So it's pretty handy in that regard.
Yes, it sounds like it's very practical as well. And I'm curious, so since you published that paper, how has your understanding changed since that time? Is there any specific differences you might point out in the data or anything along those lines?
This was published in 1993. And if I told you I'd learned nothing since then, I think I certainly would be disappointed. My wife would be disappointed. Mama would be pretty disappointed. So, I mean, that was literally 30 years ago. I'm doing the math right. So yeah, we've learned a lot. And over the course of the years, initially, people didn't have anything better to use. So, it's sort of one of the ways I think of the world. It takes a model to beat a model. And we sort of had the best model available on the shelves. So people were using it. And then through time, people discovered all sorts of problems with the model. They were called anomalies. And what anomalies to me meant was, yeah, we screwed up again. There's a problem with the model in this way, and there's a problem in the model in that way. And over time, we decided, after 20 years or so, we came back and started thinking about, okay, what can we do to clean up the model, to eliminate at least some of these problems in the model? And we ended up writing a paper where it's called the five-factor model. So 20 years later, we add two factors. I figure one factor every 10 years is a pretty good average. So that's the five-factor model, and it works a little better than the three-factor model.
Yeah, and would you care to maybe explain the additional two factors? I'm pretty sure
I think we can get into it, but it's not the idea is basically there's some other patterns in returns.
Okay.
And we learned the trick of how you form these factors. You look at the patterns and say, let me give one side of the portfolio a lot of positive weight on whatever it is I'm trying to capture. Let me give you the other side of the factor a lot of negative weight. We short a bunch of stocks that are the opposite of the high expected returns. So we're maximizing the difference in expected returns. And one of them is a profitability factor. The other one's an investment factor. And what we think both factors are doing is helping predict future expected cash flows. So it's essentially tying down a little bit more about differences in expected growth so that when you see the sorts of ratios we're looking at, you learn more about expected return.
Yep. Yeah, and one final question here. So, I think we mentioned that, it's been about 30 years. I think the 30th anniversary of the model was last year. What legacy do you think that the model has left on the industry and in academia?
I'm sorry, what?
I was saying, I think it's been about 30 years since the
No,
model.
I understood. What was the last question?
What legacy do you think the model has left on both industry and
I mean,
academia?
it's been replaced, right? I mean, there's certainly lots of people who do factor investing. The basic idea is you can use these factors to identify different tilts that you might want in your portfolio. And then you can argue about what the meanings of these different tilts are, what the benefits, what the costs, but it's just a way to frame. I mean, if you went back and looked at mutual fund databases, back when I was doing my dissertation, the names of the different types of mutual funds, it was essentially meaningless. I could never figure out what one name meant relative to another. Now, at least people understand, this is a small stock or this is a value stock. The terms people are using are now much more meaningful. And it helps people when they're forming their portfolios to have something concrete to think about when they're designing their portfolios.
Okay, perfect. Thank you. Okay, so in 2021, you wrote a paper titled 5 Things I Know About Investing. Why did you find this important to write about?
It's kind of a funny story. I got COVID, and some folks in the audience, I suspect, have had long COVID. And one of the bizarre symptoms that hits some people with long COVID is brain fog. And brain fog basically means you're just not as smart as you usually are. And what I realized was I had brain fog. I mean, I may not be the brightest person in the world, but I was smart enough to realize I wasn't as bright as I used to be. And I continued to try to do research, and it was pretty eye-opening. The brain fog just prevented me from doing research. And roughly about the same time, I got a call from a colleague of mine at Tuck, a guy named Kevin Keller, who is a really great marketing professor. And he had written a paper called 5 Things I Know About Marketing. And he said, you ought to write a paper, 5 Things that I Know About Finance. And I decided, well, I can't do research. Maybe I can write some summary of things I've learned over the years. And I realized 5 things I know about finance is too general. Let me do 5 things I know about investing. And what I basically did, I've been teaching investing for a long time. And I basically took the opportunity to summarize the stuff I had been teaching to my students over the last 25 or 30 years. And so it was just a great opportunity to summarize what I had learned by teaching. And it, fortunately, because I taught it enough, it was already organized enough in my head that I could write it down. I couldn't create any new ideas, but I could summarize ideas I'd already had. So I kind of am proud of the paper. I think it does a good job summarizing what I've learned over the years. And I've spoken to a lot of financial advisors. I've spoken to a lot of individual investors, shown them how I think about investing and gotten their feedback and improved my arguments. And it's a different way than most people think about investing. But for me, it's a far more sensible than the way most people think about investing.
Yeah, and we're very lucky that you're able to summarize that all in one, accessible piece. So I'd like to start with the first concept that you list in the paper because of the unique way you address it. Risk is uncertainty about lifetime consumption, broadly defined. What do you mean by this?
What I mean is risk is not what most people think it is, at least to individual investors. So I used to ask my students, what risk meant. And I would get, 5 or 10 different answers. None of them made any sense to me in most circumstances. So I finally said, okay, here's what I think risk is. And risk to me, and I'm going to be very precise here, risk to me is uncertainty about lifetime consumption broadly defined. And when I say broadly defined, I mean it's the consumption that I'm defining broadly. So if you ask yourself, why do people invest? What they're trying to do is move consumption through time. Typically, economists would say we're trying to move wealth through time. That's not the goal. The goal of moving wealth through time is changing when you consume. So what I mean by that is, if I put money in the bank today or money in the stock portfolio today, at some point I'm going to take it out. Why? Because I want to use it to consume something. And when I say consume here, that's what I mean by broadly defined. It's anything you might do with your wealth. And what that leads to is uncertainty about how much I will be able to consume in the future. That's what I think people should worry about. That's the risk inherent in their investment. And let me give you some examples. The senior folks at Enron, many of you are too young to remember Enron, but Enron was a consulting firm that blew up quickly. It was one of the most prestigious, most successful firms, and it just exploded. Imagine all of the senior folks, or almost all of the senior folks at Enron, had all of their retirement savings in Enron stock. The day the firm blows up, they have to go home and explain to their spouse, not only did they lose their job, they lost all their retirement savings. That's failure to understand what you're investing for. What risk means in that case, they're thinking variance. No, lifetime consumption. Nobody who was thinking about lifetime consumption would say, yeah, let's put all our consumption eggs in one basket. I'll get my income from Enron and I'll make my investment in Enron. So my retirement will be in Enron. Let me give you another example. When I went to work at Kodak, that's how I arrived in Rochester. I went to work at Kodak. That was in June of 1975. At the time, their stock price, I've forgotten exactly what the number was, but it was roughly $140 a share. When I quit to go back to the MBA program full time, like 18 months later, Kodak stock was about $46. And there wasn't a split in the meantime. Many of the older folks that I was working with had planned to retire in the next few years. They couldn't. Why? Kodak had this program. Almost everybody that had been at the firm for at least 5 years got roughly 20% of their compensation in the form of a bonus. And Kodak would give you a substantial discount on the stock price if you took your bonus and put it in Kodak shares. So all these folks had doubled down and said, let's go for it. I get a discount. Let me put all my bonus, all my retirement savings in the Kodak stock. Kodak stock tanks from 140 to 46. Their retirement has to be delayed by 5, 10, whatever number of years it takes, because they're a lot poorer than they thought they were. If you're thinking in terms of uncertainty about consumption, that's not sensible. On the other hand, most people get one investment strategy correct from this perspective. Almost anybody that owns a home has homeowners insurance. If you think of homeowners insurance from an investment perspective, it's a horrible investment. It looks like you're buying lottery tickets. You know you have a negative expected return, unless you're an arson. You know you have a negative expected return. Why? Because the company is willing to sell it to you, and they think they're going to have a positive expected payoff. Across all of their clients, they expect to make money. So you got to expect to lose money. Why do people do this? It looks like a big lottery ticket. Once in a while, it pays off a lot, but most of the time you lose, and the expected payoff is negative. We don't encourage our students to go out and buy lottery tickets, but I would still encourage them to go buy homeowners insurance. Why? Because it's a great hedge against uncertainty about their consumption. When their house does burn down, yes, your lottery ticket paid off. Well, I hope it doesn't happen to you, but if it does, that means you've got insurance against your house and reducing the variance of your consumption. It's a great hedge against consumption risk, which is the sort of thing that you'd like to do with your consumption or with your investment portfolio. So when I think about structuring somebody's portfolio, what I always focus on is, okay, where are your risks? And it's not where's the volatility in your portfolio, but where's the volatility in your consumption? What is it you'd like to consume in the future? How can you manage that risk about your consumption? So for me, I plan to own my house until I die. The value of my house is my kids' problem, not mine. What I've done by purchasing my house, I've locked up a huge slug of my consumption. Eliminate that risk. I've got the house. I've taken care of that risk. Takes it right off the table. It's like buying a risk-free asset if you're thinking in terms of a standard investment model. So bottom line for me, risk is uncertainty about lifetime consumption, broadly defined. And when I say broadly defined, I mean include in there, bequest motive when you die, stuff you're going to give your kids, political contributions, donations to your favorite charity, all the things you might do with your wealth, that's in that package. When I say broadly defined consumption, you're trying to manage the uncertainty about that.
Okay, and with broadly defined consumption, how should the investor think about day-to-day market fluctuations? Is that something that should be considered when with your definition?
To the extent that it's going to affect their future consumption, sure. I mean, stocks roughly follow a random walk. If it was highly mean reverting, okay, stocks go down today, I expect them to go back up tomorrow to compensate me. I'm not going to worry about it. A better model than that is they're just following a random walk. On a day when the stock market falls 20%, your investment portfolio fell 20%. Your wealth in your investment portfolio fell 20%.
Perfect. Okay, thank you. So the next concept you outline in the paper is the average dollar invested holds the market. In the paper, you mentioned your use of a top-down investment approach. As an investor or an advisor to investors, how would you use this approach to construct a portfolio?
Okay, so what I'm doing in this paper is trying to lay out facts. And to me, I mean, if I get the opportunity to sit across the table from anybody, almost everybody other than hedge fund managers will accept the idea that risk is uncertainty about consumption. It's a fact. And hedge fund managers, in their personal lives, they get it too. But in their professional lives, they're selling Sharpe ratios. So to them, risk is the variance that's in the denominator, or standard deviation that's in the denominator of the Sharpe ratio. But most people, once you get to talk to them, they get it. That's why they're buying house insurance. So another fact that I'm absolutely certain is I aggregate up the portfolios of all investors in the world. It's got to be the global portfolio of all financial instruments. All financial assets in positive net supply, they're in that global portfolio. So what I know then is the average dollar invested by the value weight average of all investors is that global market portfolio. Why that matters is I say, okay, if I looked like the value weight average of all investors, so my tastes, my opportunities, my wealth, value weight average of all investors, then probably the value weighted average market portfolio would be a reasonable portfolio for me. So when I talk about this top-down approach, that's where I start. I start with that market portfolio and say, look, if I looked like the value weighted average of all investors, that global market portfolio is probably a pretty good portfolio. But I don't. For one thing, I live in the US. Most of what I consume is in dollars. Most of my friends are here in the US. If I'm trying to keep up with the Joneses, that's going to matter a lot to me. There's all sorts of reasons I might want to tilt my portfolio more toward the US than the global value weight market portfolio is tilted toward the US. So I'm going to lean toward the US. I'm older than the value weight average investor. At least that's my guess. I'm almost 70. So I got to figure, okay, I'm older than the value weight average. That's probably going to, by itself, push me more toward bonds in my portfolio. I got less human capital, for example. I have less opportunity to react if the market goes down by working harder. It's sort of the way I always callously say it to my students is, if I'm a 70-year-old and I have all my wealth in the market and the market tanks, well, hello, welcome to Walmart. Suddenly have a new career. So I'm old. I'm probably, for that reason, wanting to tilt my portfolio a little away from stocks and more toward bonds. On the other hand, I know myself well enough at this point. I think I'm less risk averse than most investors. That pushes me in the other direction. And I'll tell you pragmatically how I decide how much stock to have in my portfolio relative to how much bonds. And this, I know, drives many financial economists nuts if I say it in front of them, so don't tell them I said this. But what I do is I try to get the balance between stocks and bonds in my portfolio so that on days when the market goes up, and I regret I didn't have more stock, it's about the same regret as the days when the market goes down, and I'm sorry I had so much stock. So if I can get that balance right, and I weight it roughly in my head by stocks tend to go up more than they go down. So if I can get that balance right, then I'm pretty happy with my allocation. I know there's no science behind that, but I'm sort of minimizing my regret. And it just means, okay, that's a portfolio I can live with as well as any other portfolio. So
Yeah, it helps you sleep at night, right?
it helps me sleep during the day.
Oh, okay, even better.
Exactly.
Okay, perfect. Okay, so let's move on to another very important fact in your paper. Chance dominates realized returns. Can you explain why it is so important for investors to think about both expected returns and unexpected returns when making investment decisions?
Sure. Let me start by pointing out that evolution seems to have prepared people to see patterns where they don't even exist. So the way I imagine this is we're all, our ancestors are out on the savannah. One of them looks over at a bush and kind of thinks there's a lion behind the bush. And he has two choices, say, nah, it's not a lion and just stand there. Or say, oh, that pattern, it could be a lion. I better get out of here. Whose genes survive? It seems like the guy who ran away, it was his genes that survived. And as a result, evolution has prepared us to see patterns even where they don't exist. And, you're in Rochester, you see a snowbank, you look at it, and you see a face. You look up in the clouds, there's a sailboat, or there's a sheep, or there's all sorts of patterns that your brain is just hardwired to say, oh, I know what that is. That's a face, or that's a sheep, or that's a sailboat. We tend to do the same thing anywhere where there's just noise in the data. People see patterns. And you explained it already in your question. I always say, not just me, lots of people say, the return on a portfolio or the return on a stock, it's easy to break it into two parts. there's the expected return, and there's the unexpected return. When we're paying attention to returns to build a portfolio, the reason you're paying attention is you'd like to identify the expected return. You don't want to buy a particular stock simply because it went up in the past. You might say, well, the fact that it went up in the past is evidence that it's going to go up in the future. Okay, now that's a legitimate reason. If you really are convinced that it's going to go up a lot in the future, then by all means, fine, that's a good reason. But what most people think is they observe the realized returns and project those forward. What you really need to do is disentangle the difference between the expected part and the unexpected part. And over most horizons, the unexpected part absolutely dominates realized returns. If I think about the cross-section of realized returns over a year, 5 years, 10 years, 15 years is dominated by the unexpected component. What that means is people are going to see patterns that aren't really there. Again, we're hardwired to do that because of evolution. So let me give you a great example. There's a portfolio called FANG stocks. It's Facebook, Apple, Amazon, Netflix, and Google. If you put together that portfolio back in, where's my data here? Go back to 2012 and hold it for 10 years. Between 2012 and 2021, the average annual return on that portfolio was 30%. Over the decade, the compounded return, 1,166%. So this is a huge portfolio, large stocks, 5 very large stocks that just shot the lights out. In 2020, they had an incredible year. Remember, I'll remind you, that was the year we started with COVID. What were we all doing? We were all locked down.
Yep.
So how do you think Facebook, Apple, Amazon, Netflix, and Google did? It's all the things people were consuming, right? Their return that year was 61.5%. The value weight average of those 5 stocks, 61.5%. Should I look at that 61.5% and say, that's what I expect to happen in 2021 or 2022 or 2023? No, that's almost all unexpected. Unless you were predicting COVID back in 2019, you wouldn't have been smart enough to say, let me put 100% of my portfolio in these 5 stocks. That would have been crazy. That's the difference. The expectation, it was just a normal year. The realization, it was an astronomical year. So what that means is when you're building your portfolio, you have to disentangle the expected part from the unexpected part. Now, I built my career on identifying patterns in expected returns. There's huge incentives for academics to do it. You can get help. I did. You can get tenure from identifying patterns. If you're in the business, selling financial services, you can make a killing identifying patterns. And it's going to take a long time for people to realize, oh, that pattern wasn't real. You're out there selling, I don't know, whatever it is you think airlines are great stocks. You're out there selling. How many years does it take to prove airlines weren't a great stock? Well, let me recalibrate for you here. Suppose I take the absolute best hedge fund manager in the world. After fees and expenses, her expected alpha, her real value added in an expectational sense, is 5% a year. If she has equity-like volatility in her hedge fund, how many years will it take to get a t-statistic of 2 on average? Usually I have to stop and explain what a t-statistic is. Okay, I'll do that here, but I don't
I was
think
like,
I
yeah,
need to.
please feel free.
I don't think I need to, but it's sort of when people look at polling data and they talk about margin of error, what they're looking for there is a t-statistic of 2. It's just a benchmark. Is this thing, can I be reasonably confident this is different from 0? So how long would it take to be reasonably confident that this great hedge fund manager, truly 5% after fees and expenses, is delivering positive expected alpha? Well, in the interest of time, I'll tell you the answer. It's 64 years. So this is the best hedge fund manager. It takes 64 years on average to say, yep, probably I have some real skill here. It's 3 investment lifetimes. There's so much noise in the process. People simply don't understand it. And they think there are patterns in the expected returns. There are certainly patterns in the realized returns. But typically, those patterns don't carry over to what we really care about. We're trying to forecast the future. We want to know the expected return.
Okay, and you mentioned disentangling, the unexpected from the expected. Any recommendations for how people should think about the disentangling aspect of it?
Yeah. I mean, people are going to walk into your office and try to sell you stuff based on past returns. What you want to see, ideally, is a model to justify the pattern that they think they've identified. And then on top of that, you'd like to see out-of-sample evidence. So when Gene and I wrote our first paper on the value effect, the data we were using at the time was 1963 to 1991 in the US. What did we do to sort of verify that this is meaningful? We went outside the US, looked at developed countries. It turned out 12 of the 13 developed countries had a positive expected average return on value versus growth. One of them, Italy, had a slightly negative premium. Half of the 12 were bigger, half of the 12 were smaller than the US. The US was right in the middle. We go to emerging markets. We see much stronger value effect at the time in emerging markets. And then we hand collected book equity data on every firm on the NYSE back to 1926. So we could get real out of sample evidence. Found the same thing. And then we had a simple story. High expected return, high discount rate. What that gives me is low price relative to future expected cash flows. So it's just a simple expected return price pattern that we were identifying. We could argue about why differences in expected returns, but you give me those differences in expected returns, I should see them in ratios of fundamental to price. And that's what the value effect was about. So that's, if you want to try to disentangle, that's an easy way to go about doing it.
Awesome. Okay, thank you.
You want a model, you want to see in-sample evidence, you want to see strong out-of-sample evidence.
Perfect. Well, I hope the audience will take that to heart when they're making their future investment decisions and thinking about this. So one of the final concepts in the paper is active investing is a negative sum game. Why is active investing negative sum?
I got to give Bill Sharp lots of credit for this one. He published a paper in the Financial Analyst Journal in 1991. If you're an investor and you only read one paper, this is the paper you should read. And the Financial Analyst Journal was kind enough, it's outside their paywall. You can just go there, download the paper. It's not a long paper. The paper is entitled The Arithmetic of Active Investing. And Bill was very intentional with the word arithmetic. All you have to be able to do is add and subtract. So here's the argument. Remember that global portfolio I talked about earlier? Suppose I form the global portfolio of all assets out there, the value weight portfolio, you just own everything. I choose to hold my pro rata slice of that global portfolio, and I mean stocks, bonds, anything in positive net supply that you want in your financial marketplace. So I don't have options. They're in zero net supply. I don't have futures contracts. I don't have side bets. They're zeroed out. Everything else, they're in there. I hold my pro rata slice of everything in that portfolio. What's my return? My return is going to be whatever happens to the global market portfolio, whatever the return on that portfolio is for, let's say, for the year, minus my costs. Well, this is just a passive portfolio. My costs are going to be really low. Let's say 10 basis points a year. If I think about everybody else in the world, if I took out my pro rata slice, the only thing left is that global market portfolio for everybody else to collectively own. What's their return? Again, their return's the return on the market minus their costs. But a bunch of them are out there trading actively. What they're doing is they're making expensive side bets. For every investor that overweights Apple, there must be at least one other investor that underweights Apple. The one that overweighted had to buy their more than pro rata slice from somebody else. That's just a side bet. And both of those investors are paying to play that game. Well, that cost is going to reduce the return of the aggregate of everybody else. So my return, whatever the return on the market is, minus 10 basis points. The aggregate of everybody else, return on the market minus 60 basis points, or whatever number you care. As long as it's bigger than 10, Sharp's right. And you know it is. They got extra taxes, transaction costs, fees to their portfolio manager, all the costs that I'm avoiding by just sitting on a passive market portfolio. I have to win. And it's not every decade or every year. It's literally every instant. Hey, I just won again. Hey, I won again. Every instant. I know I'm going to win just by that strategy. So what that says, it doesn't say there's nobody out there systematically beating the market. I think there are. I always point toward Bill Simons. He's the guy that ran the Renaissance Technology, the medallion fund. He made a killing year in and year out. He had like 2 losing quarters since 1993 and billions of dollars. Okay, Jim Simons beats the market. Is that evidence that I should be out there trying to beat the market? I think it's the opposite. Jim Simons would love to have me out there trying to beat him. Why? Because he knows he can beat me. I hear this story and I say, I'm going to close my wallet, not let Jim Simons take my money. So sure, there may be poker players in Las Vegas who can beat the odds. That doesn't mean I should sit down and try to beat them. So for most of us, and this is probably the most important thing I can say this morning, most of us should act as though prices are right. When we don't, we're just sacrificing a good investment strategy for something that's almost certainly going to lose. Again, I'm not telling you all prices are right. This argument has nothing to do with all prices are right. This argument is simply, there's a lot of really smart people out there trying to beat the market. I don't want to sacrifice my money to them. I'd rather make my money some other way and make it, basically, I always say, I want to make my money with my brain, not my stomach.
So are there any cases where it would make sense for someone to pursue an actively managed strategy then?
Sure. I mean, I'll give you one story. Early on, I wrote a paper, actually a couple of papers with a guy named Brad Cornell. He and I were both at UCLA at the time. And it was papers about how you price stock index futures. And it's great. I mean, everybody knows how to price a stock index futures now. It's a trivial arbitrage argument. But at the time, somebody had to write it down. Like we were the first to write it down. We got it published in I think it was the Journal of Financial Economics, actually. And fortunately for us, they just started trading stock index futures. And so Brad and I were looking to see how our formula was doing. Remember, it's an arbitrage opportunity. And we realized, hey, these prices are not so accurate. And we started trading. We pooled our money and we started trading futures contracts, basically. And doing index arbitrage. And we clearly were, I won't say we were the first, but we certainly were among the first doing index arbitrage. And relative to my salary at UCLA, we made a lot of money. We never lost money on a trade. But then our profits went like that through time. And over the course of about 3 months, prices got in line. And come to find out, it was Bear Stearns that figured out how to do index arbitrage. And they could do it way more efficiently than we could. So we quit. We didn't want to lose money. So, okay, Bear Stearns is doing better than we could. Let's get out of here. But if you truly have an opportunity like we did, don't sit there and say, oh no, I did my MBA at Rochester. Must be prices are right. But those are rare opportunities. I don't walk around every day looking for $5 bills on the sidewalk. I don't waste my time every day trying to figure out how to beat the market. But if I stumble across a $5 bill, I'm going to pick it up.
Yeah, of course. And I want to follow up on the idea that act as prices are right. So over the last couple of decades, there's been an enormous amount of money flowing into passive investing. And I'm curious what impact that might be having on the market's pricing mechanisms.
It depends on who's switching to passive. If it's people who were screwed up earlier and they switch to passive, probably it makes prices more right. If it's people like Jim Simons, who is clearly, when he does trade, pushing prices in the right direction, and he says, oh, that Ken French, he's really persuasive. I should go passive. Probably prices got less accurate. So it really depends on who it is that has become more passive. I think people overstate the level of passivity, because they look and say, oh, these ETFs, they're index funds. Well, if you look at the volume of ETF trading, it's hard to justify and say, oh, the rate of turnover in the ETFs is, let's say 200% a year. How would you justify that from a passive strategy? So I think a lot of what people are calling passive isn't really passive. It's just a different bet that people are making.
Okay, perfect. Okay, so for my last question, I'd like to address the general audience, and I'm curious, what advice do you have for students seeking a career in finance? And are there any specific skills you find most valuable for students and alumni to focus on? And maybe another way to put this would be, if there was something
that one's hard enough. Don't give me another one.
Okay, gotcha.
So what advice would I give people? Figure out ways to truly add value. And what I mean by that is a lot of folks go into finance because they want to try to beat the market. Great. If you can do that, the University of Rochester will appreciate it. They have an option on your income. If you roll the dice and you win, they'll come knocking on your door. If you roll the dice and you lose, well, they're not going to compensate you. So that's great. Go take high risk strategies. And don't forget, if you win, where you got all those great ideas. But if I'm advising my friends or my children, what you want to do in life is things where you're clearly adding value. It may have to do with offering clients a better investment strategy that they'll be able to maintain for their lifetime. Or it may have to do with, like, people often ask me what I think about cryptocurrency. My view is cryptocurrency will not survive unless people can figure out a way to use cryptocurrency to reduce transaction costs. In other words, the cost of trading cryptocurrencies would have to be lower than the cost of using your credit card. If we could buy things with cryptocurrency at far less than it costs to buy them with my credit card, great. That's a great thing. So if you want to go into crypto, figure that problem out. Solve that problem. You'll get really rich and you'll make the world a better place. So to me, that's the way to think about it. How can I add value that will help the world, and at the same time, I'll get well compensated for my contribution to what I'm doing to the world? That's the best advice I can give.
Perfect. Well, thank you so much, Ken. Really appreciate the time. And now I'm going to pass it over to the Dean, who's going to moderate a quick Q&A for us.
Thank you very much. That was very, very insightful, and I was listening with rapt attention. We have a few Q&A questions that have come in, and some of them touch upon the same point. So I'll start out here. There are a few questions about the Magnificent Seven, since that was mentioned, about their current effect on the market as a whole, and whether whether their extraordinary run should continue. I think you've addressed some of this.
Yeah.
As
I think
well.
that's the confusion of realized returns versus expected returns.
Exactly.
There's a huge component of unexpected in there.
Mm-hmm.
So I wouldn't take the past and just project it forward.
That's absolutely what your previous statement certainly said as well. And one other question, which goes back to, again, some of the things that you've talked about, active versus passive, and what does that mean if we look at the entire portfolio. But if you just look at the kind of the industry of portfolio managers today, what are the most common mistakes they make?
Oh, man. I mean, again, it comes back to that same theme. Confusing realized and expected. It's sort of, and then, yeah, I mean, if I had to say, and again, it's not as though I can point and say, that's somebody who is confused, because I don't have a crystal ball any better than theirs. It's the best I can do is warn investors that until they find compelling evidence, they probably don't want to spend a lot of money tilting their portfolio in some fashion that they don't have a compelling story for why the pattern they're chasing is real. Sort of, it's that I'm always focused on Sharpe's negative sum game. The arithmetic of active management. And I expect to lose when I sit down at a poker table. So I have to be convinced I'm at least as good as the pro that's already sitting there, or I'm not going to sit down. It's that same argument. It's sort of, why would I want to believe an active manager sitting in Rochester, New York, who has a theory about what's going to happen to the insurance industry over the next 5 years? What would that person know that somebody on Wall Street wouldn't be aware of as well? That's kind of how I always frame things. And I'm just a cynic when it comes to stuff like this. Well,
you have an incredible amount of expertise and knowledge and data and work, scholarly work, that certainly supports that. So it's great to hear your thoughts over here. So there's one more question related to the Magnificent Seven, but it's about the ETFs. The statement about if the ETFs have to churn a lot due to rebalancing, which seems to this person who's asking the question, primarily driven by tech and Magnificent Sevens. Now they make up about 29% of S&P 500. Does passive investing make more sense in this era than before, or less sense, or no more sense than before?
I'm not sure I follow the logic of throwing ETFs in there, in the sense of, okay, if they're 27% of the S&P 500, somebody who was indexing the S&P 500 before their ETFs would have put 27% of their wealth in those stocks as well. The ETF seems like a totally red herring to me. Mm-hmm. And again, if folks think those 7% or 7 stocks shouldn't be 27% of that portfolio, I presume there'll be selling pressure and price will go down. What is it that somebody doing this analysis knows that other folks on the street couldn't read in the Wall Street Journal? That's kind of, I will tell you, I try to avoid being on I'm on a few nonprofit boards. They always want me on their investment committee. And my first time I was asked, I said yes. And then my experience was wonderful for the next year because it gave me a lifetime of examples of dumb things people say. And unfortunately, the staff loved me. The other folks on the committee really didn't like me. So after about a year and a half, I went to the CEO of the nonprofit and said, look, I joined this because I want people to like me. I came to this, this nonprofit because that's sort of people that I'd like to get to know. And all I'm doing is pissing them off. I think I better get off. So they asked one of my close friends who I had recruited to the board to replace me on the investment committee. And this is a very successful hedge fund manager. And he told them when they asked that he would say everything I'd been saying. And they rescinded their invitation. So basically, and the statement that I kept asking was the same one I've been saying in response to your questions. What is it that the person asking the question knows that the people couldn't have learned from the Wall Street Journal? And I would ask the managers who came in telling their story, why are you loaded up on lumber stocks? And they would tell me a story that they'd been reading in the Wall Street Journal. And why do I think the market has underreacted to that rather than overreacted to that? I'm not saying the market didn't over or underreact. I just don't have a clue about which direction.
Well, that's certainly true. Well, it's just been an incredibly insightful discussion. I want to thank you, and I want to thank Philip for this great Q&A. Can you continue to make us really Simon proud? And it was wonderful to listen to your journey from the MBA with all the faculty at Simon whose impact and legacy we still continue to really cherish and learn from. And we're truly grateful for the time you've taken today to share your knowledge with our community and to about 100 of our students, alumni, and faculty who have joined us on this webinar. Thank you for joining us today. We thank you for your time as well and hope to see you at another Simon webinar very soon.
Thank you very much. And thanks to Philip for his great interviewing skills. I really appreciate it. And thanks to everybody in the audience. I love talking about this stuff, and my wife is really tired of hearing it. So the opportunity to talk to somebody new is great. Thank you.
You're welcome back anytime. Thank you.